In 1873, Germany stopped minting silver coins. Within 2 years, 16 other nations followed. It wasn't a conspiracy, it was a cascade. By 1900, silver, the monetary metal used for 3,000 years, had been abandoned by nearly every major economy on Earth. Today, registered silver inventories at the COMEX, the exchange that sets the price for the world, have fallen to 27.3 million ounces. That's the lowest level since October 2008. So here's the question. When the metal that once was money disappears from the warehouses of the system that replaced it, what exactly is breaking? For most of recorded history, money wasn't a belief system. It was a physical object. And more often than not, that object was silver. The Roman Empire paid its soldiers in denarii, coins that were 90% silver when Nero took power in 54 AD. A single denarius could buy a day's worth of bread for a family. A soldier's annual salary was 225 denarii. That wasn't just a currency. It was a contract between the state and its people, written in metal. The Spanish Empire extracted 150,000 tons of silver from the Americas between 1500 and 1800. Most of it came from a single mountain in Bolivia, Cerro Rico, the rich mountain. At its peak, the city of Potosi, built at the base of that mountain, had a population of 200,000 people. It was larger than London or Paris at the time. The wealth didn't stay in South America. It flowed to Spain, then to China, India, and the Ottoman Empire. Silver was the blood of global trade. China, for 2 millennia, ran its entire economy on silver ingots called sicai. The Ming Dynasty, in the 1500s, required tax payments in silver. When Spanish galleons arrived in Manila carrying Mexican silver, Chinese merchants traded silk, porcelain, and tea for it. The demand was insatiable. By 1600, 1/3 of all silver mined in the Americas ended up in China, not because China wanted to hoard it, but because silver was the only thing European traders had that China needed. Silver wasn't just money, it was the operating system of global trade. If you wanted to buy silk from China, spices from India, or grain from Egypt, you paid in silver, not promises, not paper, metal. Because metal couldn't be printed, it couldn't be debased overnight. And it couldn't be inflated away by a king's decree. The Spanish silver dollar, officially called the piece of 8 because it could be divided into 8 smaller coins, became the world's first true reserve currency. It circulated in Europe, Asia, and the Americas. Even after the United States declared independence in 1776, the Spanish dollar remained legal tender in the U.S. until 1857. When the Coinage Act of 1792 created the U.S. dollar, it defined it precisely: 371.25 grains of pure silver. That wasn't symbolic, that was the dollar. The paper notes issued by banks were just receipts, promises to pay silver on demand. But in 1871, something changed. Germany, newly unified after the Franco-Prussian War, received 5 billion francs in war reparations from France. Otto von Bismarck, the Iron Chancellor, made a decision. He took that gold and used it to back a new currency, the gold mark, and he stopped minting silver thalers. Within 18 months, silver's purchasing power began to collapse, not because it became less useful, not because new mines flooded the market, but because the world's monetary hierarchy was shifting. Nations that wanted to trade with the new German Empire, the rising industrial power of Europe, needed gold. Silver, suddenly, was obsolete. By 1873, Austria-Hungary had suspended silver coinage. The Netherlands followed. Then Scandinavia. The Latin Monetary Union, France, Belgium, Italy, Switzerland, stopped minting large silver coins. In the United States, the Coinage Act of 1873, later called the Crime of '73 by silver advocates, ended the free coinage of silver dollars. The Treasury would still mint silver, but only at the government's discretion, not at the request of citizens. By 1900, most of the world had demonetized silver. The metal that had been money for 3,000 years was now just industrial material. The gold standard had won. But the gold standard, as it turned out, had its own problems. On July 1st, 1944, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. World War II was still raging. D-Day had happened 3 weeks earlier. Soviet forces were advancing on the Eastern Front. But the question on the table wasn't how to win the war. It was, what comes after? The gold standard had collapsed in the 1930s. Britain abandoned it in 1931. The United States effectively left it in 1933 when President Franklin Roosevelt banned private gold ownership and devalued the dollar from $20.67 per ounce to $35 per ounce. What followed was a decade of competitive devaluations, countries racing to debase their currencies to gain export advantages. Trade collapsed. Bank runs spread. Economic chaos fed political extremism. The architects of the post-war order wanted stability. They wanted a system. 2 men dominated the negotiations. John Maynard Keynes, representing Britain, proposed a global currency called the Bancor that would be used for international trade, with each nation's currency pegged to it. Harry Dexter White, representing the United States, had a different idea. The U.S. held over 20,000 tons of gold, more than half of the world's monetary gold reserves. White proposed that the dollar, backed by that gold, should be the center of the system. The United States had the gold, it had the industrial capacity, it had the military power. Britain, exhausted by war and deeply in debt, had little leverage. White's plan won. What they created was this. The US dollar would be pegged to gold at $35 per ounce. Every other currency would be pegged to the dollar. The dollar became the hub, gold became the anchor, and the United States became the center of the financial universe. Foreign governments could exchange their dollars for gold at the Federal Reserve's gold window, but ordinary citizens could not. This was a system for central banks, not for people. It worked, for a while. In the 1950s and early 1960s, the Bretton Woods system facilitated the greatest economic expansion in human history. Europe rebuilt, Japan industrialized, global trade grew. The dollar was trusted because it was backed by gold, and the United States had promised solemnly to honor that backing. But by the late 1960s, cracks were forming. The U.S. was running deficits to fund the Vietnam War, the space program, and President Lyndon Johnson's Great Society domestic programs. Dollars were flowing overseas to pay for military bases, to buy foreign goods, to fund the Marshall Plan and foreign aid, and foreign central banks, especially France, started asking for their gold back. In 1965, French President Charles de Gaulle gave a press conference. He accused the United States of abusing its exorbitant privilege as the issuer of the reserve currency. France, he said, would begin converting its dollar reserves into gold. Within months, French naval vessels were docking in New York Harbor, loading gold bars from the vaults of the Federal Reserve and shipping them back to Paris. Other nations followed: Germany, Switzerland, the Netherlands. The math was simple. By 1971, the U.S. had $70 billion in liabilities to foreign central banks, but only $10 billion in gold reserves. There were more dollars in circulation than there was gold to back them. The system was breaking. On the evening of August 15, 1971, President Richard Nixon appeared on national television. He announced that the United States was temporarily suspending the convertibility of the dollar into gold. The gold window was closed. It has never reopened. What replaced it wasn't another metal standard. It wasn't a return to silver. It was something the world had never tried on this scale: pure fiat currency. Money backed by nothing except the authority of the state, the strength of the economy, and the trust of the market. In 1971, the U.S. M2 money supply, the total amount of dollars in circulation, was $600 billion. By 1980, it had doubled to $1.2 trillion. By 2000, it was $4.9 trillion. By 2020, just before the COVID-19 pandemic, it was $15.4 trillion. Then, in the span of 2 years, the Federal Reserve created nearly $6 trillion in new money. Today, M2 sits at over $21 trillion. That's a 35-fold increase since the end of Bretton Woods. Global debt in 1971 was roughly $700 billion. Today, it's $315 trillion. That includes government debt, corporate debt, and household debt. The United States alone owes $36 trillion. Japan owes $9 trillion. China's total debt, government, corporate, and household, is estimated at $47 trillion. The system that replaced Bretton Woods didn't anchor money to metal. It anchored it to debt, to bonds, to the promise that governments would tax their citizens in the future to pay back what they borrowed today. And it anchored it to the willingness of central banks to expand their balance sheets whenever the system wobbled. In 2008, Lehman Brothers collapsed. Credit markets froze. The Federal Reserve responded by creating $3.5 trillion in new money through quantitative easing, buying government bonds and mortgage-backed securities to inject liquidity into the system. The European Central Bank followed. So did the Bank of Japan. So did the Bank of England. In March 2020, when COVID-19 shut down the global economy, central banks didn't hesitate. The Federal Reserve created $5 trillion in 18 months. The European Central Bank added $1.85 trillion. The Bank of Japan expanded its balance sheet to 135% of GDP. Money became a tool of crisis management, and crises became routine. But here's what didn't change. The metals. Gold and silver sitting in vaults and warehouses didn't multiply. They didn't respond to press releases or policy announcements. They just sat there, finite and inert, as the paper claims against them grew exponentially. The COMEX, the commodity exchange in New York, is where the price of silver is determined, not by miners in Peru or Mexico, not by jewelers in India, by traders in Manhattan, most of whom never touch the metal. The COMEX operates on a futures market. A futures contract is a promise to deliver a specific quantity of silver at a specific price on a specific date. In theory, at the end of the contract, physical silver changes hands. In practice, most contracts are settled in cash. The buyer takes a profit or loss, and the seller does the same. No metal moves. But some contracts do require delivery, and that's where registered inventories come in. Registered silver is the metal sitting in a COMEX-approved warehouses, ready to be delivered against futures contracts. It's the physical backing of the paper market. In early 2021, registered silver inventories at the COMEX stood at over 190 million ounces. Today, they sit at 27.3 million ounces. That's an 86% decline in 3.5 years. The last time inventories were this low was October 2008. Lehman Brothers had collapsed on September 15th. AIG, the insurance giant, was bailed out. Washington Mutual, the largest savings and loan in U.S. history, had failed. Credit markets were frozen. The global financial system was in free fall. And in that chaos, people were pulling physical silver out of warehouses. But here's the difference. In 2008, central banks still had room to maneuver. The Federal Reserve's balance sheet was under $900 billion. Interest rates were 5.25% before the crisis began, giving the Fed space to cut them to zero. U.S. government debt was $10 trillion high, dollars, but manageable relative to GDP. Today, the Fed's balance sheet is $7.7 trillion. Interest rates are 4.5%, but inflation has been running above 3% for over 3 years, meaning real rates are barely positive. U.S. government debt is $36 trillion. The deficit for fiscal year 2024 was $1.8 trillion. That's during a period of economic growth, not recession. If a crisis hits, the deficit will explode, just as it did in 2008 and 2020. And then there's this. Central banks are buying gold at a pace not seen in half a century. In 2022, central banks purchased 1,136 tons of gold, the most since 1967. In 2023, they bought 137 tons. China added 225 tons to its official reserves. Poland added 57 tons. India, Singapore, Turkey, the Czech Republic, all net buyers. Why? Because when fiat money becomes uncertain, central banks quietly, without fanfare, go back to metal. Gold doesn't pay interest. It doesn't generate cash flow. But it also doesn't vanish when a government collapses or a currency hyperinflates. It's the ultimate reserve asset, the asset of last resort. But while central banks hoard gold, industrial demand for silver is accelerating. Solar panel production requires roughly 20 grams of silver per panel. Silver is the most conductive metal on Earth, and in photovoltaic cells, even a small reduction in conductivity means a significant loss in efficiency. Global solar capacity is projected to triple by 2030 as nations pursue net zero carbon goals. That means billions of new solar panels, and each one requires silver. Electric vehicles use 2 to 3 times more silver than internal combustion engines. A traditional car uses roughly 15 to 20 grams of silver in its electronics. An electric vehicle uses 30 to 50 grams. Globally, EV sales are expected to reach 30 million units per year by 2030. That's $900 to $1,500 tons of silver per year just for EVs. Then there's 5G infrastructure. Each 5G base station uses significantly more silver than a 4G station because of the higher frequency signals and the need for better conductivity. There are expected to be over 10 million 5G base stations globally by 2030. Medical devices, X-ray machines, MRI scanners, surgical instruments all require silver for its antimicrobial properties and conductivity. Semiconductors, the chips that power everything from smartphones to fighter jets, use silver bonding wire. In 2023, total silver demand was 1.242 billion ounces. Mine production was 830 million ounces. That's a deficit of over 400 million ounces. That deficit was covered by recycling, melting down old electronics, jewelry, and photographic film, and by drawing down above-ground inventories. But above-ground inventories are finite, and they're shrinking, fast. For most of history, the gold-to-silver ratio hovered between 10:1 and 15:1. In ancient Rome, it was about 12:1. In medieval Europe, it was roughly 15:1. That ratio reflected the relative scarcity of the metals in the Earth's crust. Geologically, there is about 19 times more silver than gold in the crust. But because silver was used as money for so long, and because it corrodes and is consumed in industrial applications, the above-ground stocks of silver are far smaller than gold. Today, the gold-to-silver ratio is 88.1, meaning 1 ounce of gold buys 88 ounces of silver. That's one of the highest ratios in recorded history. During the 2008 financial crisis, the ratio spiked to 84.1. During the COVID-19 crash in March 2020, it briefly hit 125.1. But it has since settled around 85 to 90.1. Since 1971, when the dollar was severed from gold, global M2 money supply has increased 35-fold. So either silver is no longer relevant to the monetary system, or the market is mispricing the shrinking supply of a metal the system still quietly relies on. Now add this. The U.S. Treasury is issuing roughly $2 trillion in new debt annually, not to fund wars or pandemics, to fund the ordinary operations of government, Social Security, Medicare, defense, interest on the debt. The interest alone is now over $1 trillion per year, the fastest growing line item in the federal budget. At current rates by 2030, interest payments will exceed defense spending. Who is buying that debt? In the early 2000s, it was foreign governments, China, Japan, Saudi Arabia. But foreign holdings of U.S. treasuries have plateaued. China has been slowly reducing its holdings from a peak of $1.3 trillion in 2013 to around $775 billion today. Japan remains the largest foreign holder at $1.1 trillion, but it hasn't increased its holdings significantly in years. So who's buying? The Federal Reserve through quantitative easing, U.S. commercial banks, which are required to hold treasuries as safe assets, and increasingly, domestic investors, pension funds, insurance companies, money market funds, who have few alternatives in a world where government bonds are considered risk-free. But here's the problem. If inflation stays elevated, those bonds aren't risk-free. They're guaranteed losses. A 10-year treasury yielding 4.5% sounds reasonable until you factor in 3% inflation. Your real return is 1.5%. And if inflation ticks up to 4% or 5%, you're losing purchasing power. Meanwhile, BRICS nations, Brazil, Russia, India, China, South Africa, are settling trade in local currencies. China and Russia are using yuan and rubles for energy deals. India is buying Russian oil in rupees. The United Arab Emirates is accepting yuan for oil sales. Saudi Arabia, the linchpin of the petrodollar system since the 1970s, has signed currency swap agreements with China. This isn't the end of the dollar, not yet, but the edges are fraying. In 2000, the US dollar accounted for 71% of global foreign exchange reserves. Today, it's 58%. The euro is around 20%. The yuan, despite China's efforts, is only 3%. The rest is a mix of yen, pounds, and smaller currencies. The dollar is still dominant, but it's declining. And in that context, rising debt, declining trust, currency experimentation, accelerating industrial demand, silver inventories at the COMEX just hit a 16-year low. Which brings us to the signal. Markets don't speak in sentences. They don't issue warnings. They speak in spreads, in ratios, in inventories, in the quiet movements of capital that don't make headlines until it's too late. In 2000, gold was trading at $280 per ounce. Analysts called it a barbarous relic. Central banks were selling it. The Bank of England famously sold half of Britain's gold reserves between 1999 and 2002 at an average price of $275 per ounce, a decision that has cost the UK billions in foregone value. In 2008, gold hit $1,000 per ounce for the first time. In 2011, during the European debt crisis, it reached $1,900. In 2020, amid the COVID-19 panic, it crossed $2,000. In 2024, it briefly touched $2,150. That's a nearly tenfold increase in 24 years. Silver, by contrast, peaked at $49 in April 2011, driven by fears of currency debasement and a wave of retail buying. Then it crashed. By 2015, it was back to $14. It rallied during COVID-19, hitting $30 in 2020, then fell again. Today, it hovers near $32. That divergence, gold rising steadily, silver lagging, has created the highest gold to silver ratio in modern history. It suggests one of two things. Either industrial demand has completely replaced monetary demand for silver, making it irrelevant as a store of value, or something is being suppressed. On the COMEX, the ratio of paper silver contracts to physical silver available for delivery is over 200.1, meaning for every ounce of actual silver sitting in a warehouse, there are claims on 200 ounces. Most of those contracts will be settled in cash, but if even a small percentage demanded physical delivery, the system would break. In 1980, two billionaire brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They bought physical silver and accumulated futures contracts, driving the price from $6 per ounce in early 1979 to $49 by January 1980. At the peak, the Hunt brothers and their associates controlled an estimated 100 million ounces of silver, roughly half of the world's deliverable supply. The COMEX panicked. On January 21st, 1980, the exchange changed the rules. It issued Silver Rule 7, which prohibited new purchases of silver futures contracts. Traders could only liquidate existing positions. The Hunts, who had borrowed heavily to finance their purchases, were forced to sell. Silver collapsed. By March, it was back to $10. The Hunts eventually filed for bankruptcy. The lesson was clear. The COMEX controlled the market. If the exchange didn't want a short squeeze, it could change the rules to prevent one. In January 2021, a community of retail investors on Reddit, organized around the Wall Street Bets Forum, attempted a coordinated silver buy under the banner "Dahrar Silver Squeeze." The idea was simple: buy physical silver and silver ETFs to expose the gap between paper and physical supply. The price spiked from $25 to $30 in a matter of days. Then it fell. The paper market absorbed the pressure. Mints reported record demand for silver coins. Premiums, the markup over spot price that dealers charge for physical metal, rose from $2 to $5 per ounce. But the spot price, determined by COMEX futures, barely budged. Within weeks, it was back to $25. Here's why. Most silver traded on the COMEX is unallocated. It's a claim on metal that may or may not exist in a specific vault. It's fungible, interchangeable, and it's settled in cash more often than in metal. Allocated silver, specific serialized bars stored in a designated vault, is far scarcer and far more expensive. The premium for allocated silver can be 10% to 20% above spot, depending on demand. Central banks understand this distinction. That's why they hold allocated gold in sovereign vaults. Fort Knox, the Bank of England, the Bundesbank, they don't trust unallocated claims. They want the metal, physical, auditable, under their control. In 2023, Poland repatriated 100 tons of gold from the Bank of England, bringing it back to Warsaw. Why? Because geopolitical tensions with Russia had made Polish officials nervous about storing their reserves abroad. Singapore has been building up its gold reserves, holding them domestically. India has been adding gold while reducing its reliance on the dollar for trade. But silver? Central banks aren't buying, because silver stopped being monetary in 1873, at least officially. Yet governments maintain strategic reserves of materials critical to national security. The United States has a strategic petroleum reserve, currently holding about 350 million barrels of oil. It has a national defense stockpile of rare earth elements, cobalt, titanium, materials needed for defense production. It used to have a helium reserve. It has stockpiles of uranium, lithium, and other critical minerals. Silver is used in missiles, in radar systems, in photovoltaic panels for satellites and military installations, in medical equipment for field hospitals, in switches and relays for advanced electronics. Yet there is no strategic silver reserve in the United States. There used to be. In 1959, the U.S. government held 3.5 billion ounces of silver, accumulated over decades from mining, taxes paid in silver, and old coin reserves. By the 1960s, the government was selling it off to suppress the price and keep the silver content of coins from exceeding the face value. In 1965, the U.S. stopped minting silver dimes and quarters. In 1971, it stopped minting silver half dollars. By 2002, the government's silver stockpile was gone, sold off, used, depleted. Today, the government holds 0 ounces of silver in reserve. The COMEX inventories are at 16-year lows. Industrial demand is accelerating, and yet the price, relative to gold, relative to monetary expansion, relative to the shrinking supply, remains subdued. That's the signal, not a prediction, a condition. Inventories falling, demand rising, price disconnected. And history says, when physical supply and paper price diverge for too long, something breaks. It happened with gold in 1971. The U.S. promised foreign governments they could exchange dollars for gold at $35 per ounce. When they tried, the system collapsed. The gold window closed. It happened with subprime mortgages in 2008. The financial system assumed that housing prices would never fall nationally, that mortgage-backed securities were safe, that liquidity was infinite. And when housing prices dropped, the entire structure collapsed. It happened with Treasury repo markets in September 2019. Overnight lending rates, normally stable, suddenly spiked from 2% to 10%. Banks that usually lent to each other stopped. The Federal Reserve had to inject $75 billion in emergency liquidity. Few people noticed. But it was a warning sign that the plumbing of the financial system was fragile. It happened again in March 2020. Treasury markets, the most liquid, most trusted market in the world, seized up. Dealers couldn't find buyers. The Fed had to step in and buy $1 trillion in treasuries in a matter of weeks to prevent a complete breakdown. The pattern is always the same. The market assumes infinite liquidity until liquidity disappears. And when that happens, the contracts don't matter. The promises don't matter. Only the physical asset does. Silver is a small market. The total value of all the silver ever mined, roughly 1.6 billion ounces in identifiable above-ground stocks, is about $50 billion at current prices. That's less than the market cap of a single large tech company. It's a rounding error in global finance. But small markets are fragile. They can't absorb large inflows without breaking. If even a fraction of the capital fleeing bonds, or seeking inflation protection, or hedging against currency instability, moved into physical silver, the price wouldn't adjust smoothly. It would snap. And the signal, the quiet, uncomfortable signal that the market is sending right now, is that the physical metal is disappearing while the paper claims multiply. Rome didn't collapse because it ran out of gold. It collapsed because its money stopped meaning anything. In 64 AD, when Nero became emperor, the Roman denarius contained 90% silver. It was a coin you could trust. A soldier's salary was paid in denarii. Merchants accepted them across the empire. Taxes were collected in them. The coin was the bond between the state and its citizens. But Nero had a problem. He was spending more than the empire was collecting in taxes. Wars in Britannia and Judea were expensive. Rebuilding Rome after the Great Fire of 64 AD required vast sums. And Nero's personal excesses, palaces, games, spectacles, drained the treasury. So Nero debased the currency. He reduced the silver content of the denarius from 90% to 80%, pocketing the difference. The coins looked the same. They weighed the same. But they contained less silver. It was a hidden tax, and for a while it worked. But once the precedent was set, every emperor who followed did the same. By 200 AD, under Emperor Septimius Severus, the denarius was 50% silver. By 270 AD, under Aurelian, it was 5%. The coin that had once been money was now just base metal with a thin silver wash. Soldiers, paid in debased coins, couldn't buy food. They stopped fighting. Or worse, they turned on the empire, supporting whichever general promised them real wealth. Merchants stopped accepting the currency. They demanded payment in goods, or in older coins that still had silver content. Trade collapsed. The economy fragmented into local barter systems. The empire didn't fall to barbarian invasions. It rotted from the inside. And the rot started with the money. In 1923, Germany's Reichsbank faced a crisis. The Treaty of Versailles, signed after World War I, required Germany to pay 132 billion gold marks in reparations to the Allied powers. Germany didn't have that much gold. It didn't have that much wealth. So it did what governments always do when they can't pay their debts. It printed money. In January 1923, the exchange rate was 18,000 marks per dollar. By November, it was 4.2 trillion marks per dollar. Prices doubled every few days. Workers were paid twice a day so they could spend their wages before they became worthless. A loaf of bread that cost 250 marks in January cost 200 billion marks in November. Life savings evaporated overnight. Pensioners who had saved for decades found their accounts worthless. The middle class was wiped out, not because Germany lost a war, but because the mark lost its meaning. The social consequences were catastrophic. Trust in institutions collapsed. Extremist parties, both communist and fascist, surged. In 1924, Adolf Hitler attempted a coup in Munich. It failed, but the economic chaos created the conditions that would bring him to power a decade later. Zimbabwe, Venezuela, Argentina, Turkey, Lebanon, Yugoslavia, the Weimar Republic, the Confederacy, revolutionary France, each had a different political story. But the monetary story was the same: deficits, debt, and printing presses. And, in each case, the population, when they could, fled to something real. Dollars, gold, land, livestock, anything that held value outside the collapsing system. Reserve currencies don't last forever. The Portuguese real-dominated global trade in the 1400s, backed by the wealth of the spice trade and African gold. But by the 1500s, Portugal's empire was overstretched, its finances exhausted. The Spanish dollar took over. The Spanish dollar ruled from the 1500s to the 1700s, backed by the silver mines of Potosi and Mexico. But Spain spent its wealth on wars in Europe, on the Armada, on maintaining an empire it couldn't afford. By the 1800s, the Spanish dollar was finished. The British pound became the global reserve currency in the 1800s, backed by the gold standard and the industrial might of the British Empire. At its peak, the pound financed half of global trade. But 2 world wars exhausted Britain. By 1944, at Bretton Woods, the torch passed to the dollar. The US dollar has been the dominant reserve currency since 1944, 80 years. The average lifespan of a reserve currency, according to a study by the Bank of England, is 94 years. The dollar is 80 years into its run, if we count from Bretton Woods. That doesn't mean collapse is imminent. It means the system is mature. The excesses are visible. The debt is unprecedented. The trust is conditional. And when trust erodes, people don't wait for formal announcements. They don't wait for a government to declare a currency dead. They move, quietly, gradually, into assets that don't require trust: gold, land, commodities, businesses, and yes, silver, 27.3 million ounces. That's what's left in COMEX registered inventories in a world of $21 trillion in money supply, $15 trillion in debt, $2 trillion annual deficits, in a world where the U.S. Treasury is paying over $1 trillion per year just in interest on the debt. In a world where inflation has been above 3% for over 3 years, eroding the purchasing power of every dollar, every bond, every savings account, every solar panel, every electric vehicle, every smartphone, every 5G tower, they all consume silver. Permanently. It doesn't come back. Recycling recovers some, but not all. and the demand is accelerating. The World Bank projects that solar panel installations will require 85 to 98 million ounces of silver per year by 2050. Electric vehicles will require another 30 to 50 million ounces annually. Electronics, medical devices, 5G infrastructure, together, industrial demand is expected to exceed 1 billion ounces per year within a decade. Mine production is roughly 830 million ounces per year, and it's not growing significantly. Most of the easy silver has been mined. New deposits are deeper, lower grade, more expensive to extract. Some analysts estimate that peak silver production may have already occurred. And if the day comes when the people holding paper contracts demand delivery, when pension funds, sovereign wealth funds, or even retail investors decide they want the physical metal, not the promise of it, and the warehouses can't provide it, the price won't adjust smoothly. It will snap. It's happened before. In 1980, silver went from $6 to $49 in a little over a year. Then it crashed to $10. In 2011, it went from $18 to $49 in 4 months. Then it crashed to $26, but each collapse found a higher floor. $6 became $10. $10 became 15s. $15 became $20. The trend, over decades, is clear. Silver isn't money anymore, not officially. The last country to use silver coins in regular circulation was Switzerland, which stopped minting them in 1967. Silver has been demonetized for over a century, but it was money for 3,000 years. And the system that replaced it, fiat currency, fractional reserve banking, central bank balance sheet expansion, infinite debt, has only existed for 50 years in its current form. 50 years. That's one human lifetime. It's a blink in the span of monetary history. And in those 50 years, we've seen the money supply increase 35-fold. We've seen debt grow from $700 billion to $315 trillion. We've seen crisis after crisis. 1987, 1998, 2008, 2020, each one requiring larger interventions. John 14, more money creation, more debt. History doesn't repeat, but it rhymes. And right now, the rhymes are getting louder. The inventories are rhyming with 2008, the last time the financial system nearly collapsed. The debt is rhyming with Rome, an empire that debased its currency until the money stopped working. The currency experiments, brick settlements, digital yuan, talk of central bank digital currencies, are rhyming with the 1930s, when nations abandoned the gold standard and devalued their way into chaos. And through it all, the metals sit in vaults, silent, finite, unconcerned with the promises made about them. The question isn't whether the system will change. Systems always change. The gold standard ended, Bretton Woods ended, the era of low interest rates and easy money ended in 2022 when central banks finally started raising rates to fight inflation. The question is, what happens when the gap between paper and physical becomes impossible to ignore? What happens when the claims exceed the supply by so much that the market can no longer pretend they are the same thing? In 1971, when foreign governments demanded their gold and the U.S. couldn't deliver, President Nixon closed the gold window. The system didn't collapse, it transformed. The dollar became pure fiat. And for 50 years that worked, because the world trusted the dollar, and the U.S. economy was strong enough to back that trust. But trust isn't permanent, it's earned, and it can be lost. When the silver runs out, not everywhere, not all at once, but in the places that matter, the exchanges, the warehouses, the vaults where price is set, what's left is a market built on promises. And promises, when tested, are only as good as the institution making them. 27.3 million ounces, the lowest level since 2008. The year the world learned that housing prices can fall, that banks can fail, that liquidity can vanish overnight. History doesn't predict the future, but it does reveal patterns. And the pattern right now is clear. The metal is disappearing. The paper claims are multiplying, and the price hasn't caught up. Not yet.